There's been a lot of talk about the recent bank collapse. But here's the honest truth. In 2023, the world was reminded of just how fragile our financial system can be. Within weeks, three of America's most prominent regional banks, Silicon Valley Bank, Signature Bank, and First Republic, collapsed in a wave of panic. Nearly $550 billion in assets evaporated, shocking depositors and shaking global confidence. For many, the collapse came out of nowhere. But behind the headlines lies a deeper story about hidden risks, misunderstood protections, and the harsh truth about how safe your money really is. This is the banking collapse of 2023. What they aren't telling you on, more importantly, how you can protect yourself before the next crisis strikes. This is part one. The regional bank failures. These weren't small-town community banks. These institutions served some of the wealthiest clients in America: venture capital firms, tech startups, and high-net-worth individuals. On March 10, 2023, Silicon Valley Bank depositors started to freak out. Rumors swirled that the bank was days away from collapse. So they did what anyone would do in that situation, right? They withdrew millions, billions of dollars in minutes. The bank's mobile app froze. It couldn't handle the flood of requests. It was too late. The damage was done. Hours later, SVB shut down. At Signature Bank, it was the same story. Early rumors, mass withdrawals, sudden closure, and then First Republic. For wealthy individuals and companies, this wasn't just a financial scare. It was a rude awakening. They thought they were too big to fail. They thought their connections, their status, their wealth would protect them. But like everyone else, they were subject to the whims of the market and the speed of technology. But here's the truth. These weren't ordinary banks. They held massive amounts of unrealized losses on their books, mostly in long-term treasuries and mortgage-backed securities. When interest rates rose rapidly, their value dropped. And when customers wanted to pull out their money, the banks didn't have it. They'd gambled on holding long-term assets, hoping rates wouldn't rise, but they lost. As their customers panicked, the damage spiraled. It became a vicious cycle of withdrawals, fire sales, and growing losses. SVB lost $1.8 billion in value in a week. It was a dizzying turn of events that left investors shaken. But here's the bigger issue, the lessons most people missed. The U.S. government feared contagion. If panic spread, hundreds of banks could fall. So federal regulators made a radical move. They guaranteed all deposits, even those far above the official FDIC limit. A bold move, but not a guarantee for the future. The next time a bank fails, there is no promise that uninsured deposits will be protected. And for anyone keeping large sums in the banking system, that's a chilling reality. Now let's move on to part two. FDIC insurance, the fine print. Now, you've probably heard of FDIC insurance. It's supposed to be the safety net that protects your money in a bank or thrift. But here's what most people don't understand. It doesn't cover every cent you have at a bank. In fact, FDIC coverage is quite limited if you don't know the rules. It's easy to overlook. You might assume the headline $250,000 limit applies to each account. But that's not the case. FDIC insurance covers up to $250,000 per depositor, per bank, per ownership category. That means if you have $200,000 in checking to get the full $400,000 of coverage, you'd need two. Spread funds across multiple banks. Choose different ownership categories: individual accounts, joint accounts, trust accounts. Want more coverage? The limits increase for certain retirement accounts like IRAs and 401ks. An individual traditional or Roth IRA has a separate $1 million coverage limit. But don't assume anything is covered simply because it's at a large, well-known bank. Coverage depends on the type of account and its ownership, not the bank's reputation. And here's what they aren't telling you. In 2023, government decided to cover balances above $250,000. But this was political discretion. It's not a legal guarantee. Next time, you might not be so lucky. Now let's talk about why traditional banks may not be enough to protect your wealth. Let's start with the basics. Why do we even have FDIC insurance? The idea is simple. It gives you peace of mind knowing your money is safe. But that peace of mind comes with limitations. Traditional banks focus on getting your deposits, offering services like physical branches, convenient ATMs, and appealing interest rates. However, they're not specifically designed to prioritize safety or maximize yields. Their main goal is usually attracting customers and turning a profit. While many banks are incredibly stable, especially those with strong histories and government backing, no one is truly immune to risk. Take Silicon Valley Bank, for example. Despite serving a high-profile clientele and being deeply ingrained in the tech ecosystem, they fell victim to poor investment decisions and a classic bank run. This serves as a stark reminder that relying solely on traditional banks for wealth preservation might not be the wisest strategy. So, where can you put your money to work while potentially minimizing risks associated with traditional banking? The answer often lies in less conventional places like U.S. Treasury bonds. Unlike bank deposits, which are only FDIC insured up to $250,000 per ownership category per bank, Treasuries are backed by the full faith and credit of the United States government. This makes them one of the safest investments globally. Regardless of the bank's health or economic conditions, Treasuries remain a reliable store of value. However, there are a few downsides to consider. Unlike bank deposits, Treasuries are not immediately liquid. They mature over time, meaning you must hold them to their scheduled end dates to receive your principal back. While you can sell them on the secondary market before maturity, the prices of Treasuries can fluctuate based on various factors, including interest rates. If interest rates rise, the value of your held Treasuries may decline. Another alternative to traditional banks is government-focused money market funds. These funds typically invest in short-term Treasuries and other government-backed securities, providing investors with easy access to their money while earning competitive yields. Money market funds can offer higher returns than traditional bank deposits, sometimes matching or even surpassing rates offered by online savings accounts or CDs. Additionally, they provide diversification benefits, spreading your money across various short-term debt instruments. This reduces the risk associated with holding any single security. However, it's important to note that while money market funds are considered low risk due to their focus on government securities, they still carry a small amount of risk. Their net asset values may fluctuate based on interest rate changes and market conditions. Additionally, although money market funds have historically been very stable, there have been rare instances in the past, such as during the 2008 financial crisis, where some prime money market funds experienced temporary drops in share price. Let's move on to Part 4. Taking action to safeguard your wealth. Deposit coverage matters, but it's not a guarantee. So what should you do to protect your money? Follow these 4 steps to safeguard your financial well-being. Step 1. Know your limits. Deposit coverage is per depositor, per bank, per ownership category. Make sure your accounts stay within the limits. Don't assume everything's covered just because it's in a large bank. Step 2. Diversify wisely. Spread deposits across multiple banks. Use different ownership categories like individual and joint accounts to maximize coverage. Step 3. Prioritize Treasuries. Invest in U.S. Treasuries, one of the safest investments in the world. Buy them directly through Treasury Direct or via your brokerage for maximum safety. Step 4. Consider money market funds. Look into government-focused money market funds. They offer liquidity, stability, and competitive yields without the direct banking risk. Review your accounts regularly. Watch for coverage limits, rebalance as needed, and stay informed. These aren't panic moves. They're smart moves. Think of them as building a fortress around your savings. And now it's time for the final part of this video, Part 5. Stay informed, stay protected. The banking collapse of 2023 wasn't just a financial story. It was a wake-up call. A warning that the rules we assume will protect us don't always apply. FDIC insurance has its limits. Bailouts aren't guaranteed and banks aren't invincible. But knowledge is power. By diversifying, investing in treasuries, using money market funds, and staying within coverage limits, you can secure your wealth against the next shock. Here's the bottom line. We live in unpredictable times. The only constant is change. What worked yesterday might not work tomorrow. Don't rely on promises. Secure your future today. Start now. Move your money. Diversify your accounts. Get informed. Don't wait for the next crisis to hit. Act today. Take control of your financial destiny. Don't leave your money to luck. Leave your worries to luck.